Hi there, welcome to Neppy Invests. So, usually in my videos, I talk about small cap companies. Some companies don't even have a revenue, but today I'm talking about the largest companies on the ASX, and they are the four big Australian banks. So, by market cap, we are talking about the big end of town, but during the last year, 2 years or year and a half or so, sentiment has been quite negative towards the banks. And I think we're almost at historic low sentiment for the banks. I've listened to a lot of podcasts, read a lot of stuff, and there's not a lot of positive sentiment around the banks. And that's why those prices are quite low at the moment. But today there was some news from the federal government that might lead to a shift in that sentiment. So let's have a look at all that. So, as I mentioned today, I'll just be focusing on the four major Australian banks. So that's NAB, Westpac, ANZ, and CBA. I'm just going to leave aside the small regional banks like Bendigo Bank and Bank of Queensland. And Macquarie Bank doesn't quite fit into this category, even though they are bank. They're a little bit of a different kettle of fish. So, is it time to buy the Australian banks? Let's discuss that. First, we have to talk about the sentiment, how low it is. So this is a Westpac chart going back 15, 16 years, looking at monthly the candlesticks here, so these monthly lines. And that big fat black line on the bottom there, around $15, was the low of the GFC and the low at COVID-19. So that is what you could call support. So any prices just on that line or above, good chance to buy in there. So we've seen Westpac as high as $40 in 2015, as low as $15, and it's right near the low right now. So you could say sentiment's quite low, valuations are quite low, just based off share price. So if you're thinking of a contrarian buy right now with the banks, this could be a contrarian buy. I think contrarian buys typically can be good if that contrarian view plays out in the long run. Not the contrarian view, but contrarian views tend to shift once sentiment shifts. So there's that. So really, it's been a tale of 2 days here. So yesterday there was some bad news. Well, not really bad news because it was expected bad news. So Westpac was fined $1.3 billion. That was expected. Nothing out of the ordinary there. But if you are thinking a conspiracy theory, or if you're a cynic, you would think bad news yesterday, and that's turned into good news today. It was just too well planned in my liking. So I think this was planned to go from bad news yesterday to good news today. And that good news today, I won't go into all these quiet quotes, but essentially Josh Frydenberg wants lower lending standards for the consumer, us. Not only lending standards, but the onus will fall on us instead of the banks. So that should make it easier for the banks to give us loans, which in theory will stimulate the economy because they'll give out more loans, and that should help along with low interest rates. If you give out more loans, that should have people spending more potentially, a bit more money in the system, that sort of thing. But the onus then falls on to us whether we make a good borrower instead of the banks deciding if we make a good borrower. I'm not sure that's a good thing at all. I won't get into whether this is good or bad. My opinion on this, I definitely have an opinion on this, so I try to leave that bias out of it. But because share prices don't really care about my opinion, they just care about potential for profits for the banks. So the reason I'm showing some of these quotes because there is quite a bit of negative reaction with this policy from Josh Frydenberg, and probably that negative sentiment in the long run might mean this policy doesn't get all the way through or even become a policy in the end, just because that negative sentiment could be a sign to Josh Frydenberg and the government that they shouldn't go through with this. So the banks are definitely for this, and there's a lot of consumer groups, Choice, that sort of thing, are totally against this. Consumer Action Law Centre's against this. So a lot of groups are totally against this policy. And this is one from, I think it was ABC News journalists, just talking about how it could be a bad thing in the long run. Won't get into the policies of this, but one thing, I won't get into the policy, whether I like it or not, but one of the things to understand is, even though this could be a good short-term thing, in the long term, will it be a good thing for the banks if they get this? Just because we're going to see increasing debts, increasing bad debts, and that could be a bad thing heading forward. We could see another bit of a financial crisis out of this policy. And historically, really bad financial crises happen because of bad government policies. So the most important thing, and the reason I'm discussing this, is the reaction in the share prices of the banks. And we did see quite a bit of bullish action today. Share price went up 7.39% in Westpac, which was the most bullish. And we've seen some good price action across the others. I have included Bendigo Bank and Bank of Queensland here just because we've seen less bullish action there. And CBA, we also said less bullish action there just because there is a bit of premium in the CBA share price simply because it is considered the best Australian bank. And because it's considered the best, usually the best have premiums. And that's what we see here. So has it led to a shift in sentiment? So this is the Westpac chart, and I'm going to say right now, no. Technically, no. We did see some good price action today, but we have, over the last 2 weeks, we've seen the share price actually drop from where it finished today all the way back to $16. So it's just risen to a price it was 2 weeks ago. In fact, the last few days actually fell below a bit of resistance or support. So because it fell through that support, that could have been a bit of a bearish. So we've gone back into a good trading range here. So the share price is just into a trading range, so nothing too exciting with this. If we start seeing a share price start to move up over the next few weeks, if we start to see the moving averages come together, if we start to see the shorter moving averaging move above the longer moving average, that's the black moving above the blue, that could be more bullish. So this is a multi-week, even potentially a multi-month event to see if there is a shift in bank sentiment. Sometimes it doesn't happen instantaneously, but there is also always a catalyst for a shift in sentiment, and today could be that catalyst, and whether it plays out in the long run remains to be seen. CBA, I would probably say this is more bearish just because we have seen actually a long-term downtrend or 2-month downtrend from $76 all the way down to about $64, and really nothing too exciting with this chart at all. So I actually think CBA has the less bullish chart out of all the ones I saw. And the most bullish one is actually NAB, just because their share price finished above the long-term moving average, which is the 100-day moving average. So maybe more bullish on the NAB chart, but still I don't think it's a buy at all, just based off technicals. So are the banks cheap? That's the other thing I'm going to look at. This is more of a value investor who doesn't really like to look at charts, that sort of thing. So I am actually full in both categories, although I do like to look at charts. So I don't look at PE ratio, I look at price to book ratio, and ideally I like to look at price to tangible book ratio. But we see on the left hand, up the top left is Westpac, top right is ANZ, bottom left is CBA, and bottom right is NAB. Westpac, ANZ, and NAB all have a price to book less than 1, which is historically low values, which means based off price to book, this is actually, they are cheap relative to historic values. And typically you will buy in or have better chance of getting better returns if you buy in at lower than historically low PB ratios. CBA is at GFC low ratios at 1.6. So the other three, I mentioned before that CBA trades at a premium, and you just see this with price to book. The other three are trading less than 1, and CBA is trading at 1.6. So if you are buying CBA, you are paying a premium. But just based off value here, looking at the PB ratio, you should look at other things too, other ratios, but or other metrics. You could say that there is value here. Compared to the world, though, it's come back to what the rest of the world trades at, the other banks there. So I've got some very similar banks in terms of market cap. So we've got Westpac and ANZ here, compared to quite a few Canadian banks. That's good sort of a comparison. And we aren't trading at much of a premium to world banks at the moment. Historically, we do trade at a premium to world banks because we are considered a little bit better banks than some of the world banks. But at the moment, you could say we've come more in line with the World Bank. So if you look at this way, at this sort of comparison, you'd say we're now in line, and then maybe there's not as much value there. But I think we should be trading at a premium, a little bit of a premium anyway. So is it time to buy the ASX Banks? These are my takes on it. So we are historically cheap. That's, I think, a given. PB ratios are historical lows. Even the prices, share prices at quite historic lows. Maybe not historic lows, but multi-year lows for some of the companies, except CBA. So more in line with the other banks around the world, suggesting maybe we've just come in line with the other banks, and maybe that's going to be sort of a trend that continues moving forward. CBA is still at a premium, so if you are thinking of buying CBA, just keep in mind that you are paying a little bit more for that company. And today's news, it could be the catalyst for the beginning of an uptrend, a shift in sentiment. I'm always looking for these catalysts for shifts in sentiment, because that's when the uptrends could begin. It hasn't been confirmed yet, so I'm waiting for that confirmation. And I still have a lot of, I suppose, trepidations about buying banks at the moment, just because there's still a lot of headwinds. Low interest rates aren't good for banks. They would prefer high interest rates because the margins between the borrowers and the lenders there. So that's what they lend at, and the interest rates for savers. Also have a morose economy, so you could see a lot of bad debts, home loans going kaput, that sort of thing, which is bad for the banks too. And it's still not a technical play at the moment, so it needs to establish an uptrend for confirmation of that this being a catalyst. So probably a little bit more bullish than I was yesterday, simply because of the price action, a bit of news. But again, that news is that policy from the government has to be still confirmed. Still not a definite. I think it probably has to go through Parliament, that sort of thing. But there is potential this could be a catalyst. So that's all for today. Hope you enjoyed this video on the banks. And if you have any comments, just leave it below. And again, I'm not a professional advisor, so don't take anything I say and use it to make some choices. If you do need some advice, make sure you speak to a professional. That's it for today. Hope you enjoyed this video, and I'll speak to you again in another video another day.